U.S. needs to get back on a sustainable fiscal path.
Anything that purchases in the first quarter or maybe early in the second quarter, right now, I would support that.
Whether it's Omicron or Delta or any of the variants, we know that vaccines are likely to have some protection.
This is Bloomberg Surveillance, Early Edition.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Here's what's coming up on today's program. The Omicron variant spreads. The U.S. reports its first case, and Anthony Fauci says it was a matter of time. Crude dilemma. OPEC Plus meets to discuss production increases. Omicron throws the demand outlook into disarray. And stay with Surveillance Early Edition this hour. We speak to the economic head at the European Investment Bank and to the co-chair of COVAX. Send in all of your questions at IB Plus TV Go. First, let's check in on the markets. It's shaping up to be another ugly day. We're looking at European equities falling 1%. This is really a game of catch up to what happened in the U.S. yesterday. In the U.S., you had Powell reiterating his hawkishness. You also had the first case of Omicron reported in the U.S. But when that happened, Europe was still closed. We ended the day higher yesterday, so this is starting to look a lot like the U.S. session. Now, the U.S. futures are moving higher by about 0.5%. But adding to that turmoil is what's happening in tech. Tech, the worst performing sector here in Europe, down more than 2.5%. Apple reportedly warning its suppliers about demand for the holiday season. We're also seeing some selling coming into the 30-year yield. We saw mostly buying yesterday, perhaps a little bit of bid for protection. Yesterday, our guest Rupert Harrison told us from BlackRock that he still likes government bonds as a source of protection. And finally, the lira. It's another new head over there at the central bank. This continued turmoil in Turkey means the lira falling towards another record low. It's lower by 1.3% versus the dollar. Let's go ahead and also get your look at what's happening in Europe. We looked at the sectors, but it's also mostly red for European countries as well. The only ones that are declining more than 1%, you have the DAX, you have Italy, you have Spain as well. A little bit of outperformance when it comes to UK stocks and the CAC are on. I should say outperformance, but they're still down about 0.9% and 0.7% as well when it comes to these UK equity indexes. And again, a lot of this has to do with Omicron, and Omicron has officially reached the U.S. The CDC has confirmed a case in California. Now, the patient was fully vaccinated, has mild symptoms that are improving, and is currently self-isolating, according to them. But top U.S. infectious disease doctor Anthony Fauci was hardly surprised by the development.
We knew that it was just a matter of time before the first case of Omicron would be detected in the United States.
Now, over at the Fed, Loretta Mester says she's open to faster tapering to win space for potential rate hikes. The Cleveland Fed president told Bloomberg exclusively that higher rates in 2022 may be needed.
Right now, with the inflation data the way it is and with the job market as strong as it is in many dimensions, I do think that, we have to be in a position that if we need to raise rates, a couple of times next year, we're able to do that. So again, quickening the tapering gives us that optionality.
We're joined now by George Saravelos, Global Head of FX Research at Deutsche Bank, and Ven Ram from our Markets Live team. George, I want to start with you. We heard from Loretta Mester there, seeming to coalesce this now moving consensus of 2 rate hikes. Is that your consensus over at Deutsche Bank as well?
So we've also moved to looking for rate hikes from the Fed next year. And I think the key point is if you look at, for example, Omicron, there's this idea in the market that somehow it's this big shock, this big change to the outlook. But we've had these variants throughout the year. And if you look at how the market's been behaving, yields peaked back in March when we were most optimistic on the vaccines. And ever since, we've been going through these waves. And the reality is it's these waves that have caused weak labor supply in the US. They've caused excess goods demand, causing inflation. So I think, if anything, this Omicron debate is actually pushing the Fed even more in the same direction.
Oh, interesting. Well, let's work through some of the market action then that was a cause of that. And Ben, let me bring you into this as well. We saw this bid to longer dated paper yesterday. We saw an equity sell-off. Would you categorize it as logical market action?
Yes, absolutely, Danny. I think it is the taste of things to come, as we discussed earlier, because you've got a scenario where Loretta Mester said that, look, 2 rate hikes are possible in next year, and that will mean that 2-year yields are going to be uncorked higher based on correlations with what has happened in previous Fed hike cycles. And if the 2-year yield and the 10-year yield kind of rise, it is a law of gravity that will work on stocks to bring them down, because you will be using higher discount rates to value stocks. And stocks had a very good 2021, at least until the end of November, because all we got was taper, so there was not a significant change in the discount rate. But if you're going to change the discount rate next year, then that means that stocks will feel wobbly.
Well, to Ven's point, George, we've seen yields in the front end of the curve move higher and at the same time flattening, and in some parts of the curve even inverting. What do you make of that?
So I think it's impossible to understand what's going on in the economy and the markets this year without having a framework for long-term yields. Because the reality is you've had massive inflation surprises, a lot of central bank hawkishness, and yields in the back end have not moved. And I think the answer to that is actually COVID. It's proven more persistent than we thought. It's causing excess saving. People are saving, they're buying equities, they're buying Bitcoin. They're also buying bonds. You can see that in the data. But also trend growth is falling. The market's pricing low terminal rates. And you can see that, for example, in labor force participation. In the US, it's the lowest since 1976. So all these things in the background, they're helping front-end yields go up. We're pricing more inflation risk. But at the same time, the long end can't sell off. And I think that's really critical to understanding what's going on this year.
Well, another thing I'd like to try to understand, and I happen to know that Ven has been writing about this on the MLive blog, so I want to get his take first, and then, George, see if you agree. And that's the recent strength we've seen in the euro. Despite Omicron, Ven, for the most part, it has been benefiting some of the haven currencies. What's your explanation for it?
Well, the way I think about it, Danny, is that a massive risk-off, i.e. one that compels the Fed to go easy on rate hikes, that will be positive for the euro, because that will mean the global risk-off dominates, Omicron dominates, global growth stagnates. That will mean a bit for the euro relative to the dollar. But if the dominant narrative becomes the Fed rate hikes and tightening all over the world in the rest of the G10 world, and Omicron just lurking in the background, Omicron and other variants just lurking in the background, tangentially impacting the economy without doing too much damage, in that scenario, I see that the US dollar will be bid, which is why you've seen this uneasy kind of seesaw going on between the dollar and the euro ever since news of Omicron broke last week.
Would you agree with that view from Ven?
So I think in contrast to the bond market conundrum, so to speak, there's no conundrum in FX. If you look at the relationship between the dollar and yields, it's exactly as you'd expect. Very sensitive to the front end. You saw this euro squeeze over the last few days because the market took away pricing of Fed hikes. Now it's added them back in. So I think that short-term relationship is very, very robust. If the Fed is hiking more next year, then the dollar should be strengthening and vice versa.
So is it euro weakness from here on out then?
Well, I still think the risks are for more euro weakness. And one underappreciated story is how disappointing European flows have been this year. So if you go back to the start of the year, the expectations, including my own, where you would see these massive inflows into Europe, the reflation trade, they never materialized. And instead, you're seeing very big European outflows as Europeans are back to doing what they've been doing for the last few years, buying US equities and buying US bonds. So the European flow picture, irrespective of the Fed debate, is also quite negative.
Fair enough. And that does seem to be a consensus emerging. Ven, is this what you're hearing? And specifically on the dollar in terms of the greenback's direction?
Well, I do think that if the Fed continues to push on with its taper faster and starts raising rates, I do think that the dollar is upside. And I would see that, last year at this time, I called for the dollar, much stronger dollar, at a time when no one was calling for a strong dollar, and that has played out exactly according to the script that MLive predicted. So we've had a pretty strong dollar, pretty strong run up in the dollar, and I expect that to continue, albeit I think that the gains will be kind of moderated next year. We won't see the kind of run up that we have seen this year. Maybe 2 to 3% is what we are looking at.
All right, Ven, thank you very much. That's Ven Ram from our Markets Live team. George Sailor-Velis from Deutsche Bank is also here with us. He's going to be sticking around as well. I also want to get us a quick pre-market check on Apple as well. Falling as much as 0.8% in the pre-market trade. Some other Apple news as well. We also have Apple partner Foxconn in talks to help Saudi Arabia build EVs, so perhaps that's a boost for them at a time when Apple, according to Bloomberg sources, is warning its suppliers about potential demand weakening into this holiday season for its iPhone 13. So we've seen a lot of read across to suppliers, and there you go, Apple falling more than 1.3% in the U.S. pre-market trading. Smart Conversations continue on Bloomberg Surveillance Early Edition. This hour, we're going to be discussing vaccine access with the co-chair of COVAX, and we're also going to be speaking to European Investment Bank's head of the economic department, about the state of EU business investment. Any questions for them or George? Send in your questions on IB plus TV Go. And of course, we're going to continue to talk FX, and we're going to talk Turkey after it replaced its finance minister. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, Turkey's central bank says it is able to intervene to reduce what it describes as excessive volatility. That comment comes after yet another change at the top of Turkey's finance ministry. President Erdogan has appointed Nuruddin Nebati as the new finance minister, replacing Lutfi Elvan after a little more than 12 months on the job. The move has weakened the lira back towards a record low. Joining us now is Bloomberg's Simin Demirkan from Istanbul. Simin, set the scene for us. What's the reason behind the move?
Well, over the past few weeks, there could have been disagreement over the new economic policy. Of course, President Erdogan has been pushing for aggressive rate cuts despite high inflation and also undervaluing the lira. We were hearing speculation for a few weeks that Lutfi Elvan could actually step down himself. Now, he's been replaced by Nuruddin Nebati. He was the former finance minister, and he has close ties with President Erdogan's son-in-law, Berat Albayrak. Of course, Albayrak himself was the finance and treasury minister back in 2018. He resigned himself late 2020. Nebati, over the past few weeks, has been voicing support for President Erdogan and his aggressive rate cuts.
Simin, thank you very much for staying on top of this story for us. That's Bloomberg's Simin Demirkan in Istanbul. And George Saravelos from Deutsche Bank is still with us. A lot of volatility in this market, obviously. Is the lira one that you'd want to play in right now, or are you staying on the sidelines?
So the first thing I look at when you see so much volatility in emerging markets is the net international investment position. That basically tells you a country's exposure versus the rest of the world. And is there a big FX risk there? Are there balance sheet risks? And if you look at Turkey, there isn't really a huge source of balance sheet risk. A lot of the negative net international investment position is foreign direct investment. Foreigners have bought into Turkish companies, into stocks. So there's no very big underlying systemic risk on the back of this FX depreciation. So the risk is it just keeps going, I think, until the market reaches a new equilibrium.
Let's talk about a risk in another emerging market, if we can call it that. China, we're seeing the yuan continue to strengthen, multi-year high versus the dollar, even though there's been concerns about economic growth in China. How do you account for the strength there?
So I think the answer is COVID. You have record surpluses versus the rest of the world. The rest of the world is not going into services. It's still reluctant to go to restaurants, to travel. So we're all buying more goods. And China is at the epicenter of global goods distribution. So the external accounts are extremely strong. But China is still pursuing the zero COVID strategy. So you're not seeing the outflows. You're not seeing China services, China tourism, for example. So the external accounts are very supportive, and that's why you're seeing this counterintuitive scenario where the currency stays very strong, even though the economy has been quite weak.
Does that mean, kind of in a perverse way, that the risk to the yuan is normalization and normalization of COVID and being able to get out and mobility being restored?
Absolutely, and that's why I was writing earlier this week on the back of this Omicron news that the risk is China still stays very cautious. It delays China reopening. It delays so-called normalization in everything, and that, ironically, allows for a stronger yuan.
Well, at the same time, other EM currencies trading near record lows. The JP Morgan index of EM is at its lowest since they started the benchmark in 2010. How much risk is there, considering the Fed is now starting to head towards this path of tightening at a time where emerging market currencies are already relatively weak?
So the single most important variable, I think, for emerging market currencies is relative growth. If you go back to 2010, 12, when you had this huge EM outperformance, EM growth was doing much better than DM. And now you're seeing the opposite. Emerging markets have lower vaccination rates. They have issues around fiscal policy. They have big issues. Some have big issues around inflation. That's why central banks are tightening so much. But all that means, on a relative basis, EM growth underperforms. And I think the risk is you do continue to see EM currencies underperform as well.
This just reminds me of how far we are away from the world pre-COVID, when the story was synchronized global growth. What I'm hearing from you is we are nowhere close to that.
Absolutely. So I think a big part of the market hope, the market narrative in Q1 was that the vaccines would somehow save the world, would go back to the old normal. And I think what's happening is we're in a new normal where all of strange things are happening. US labor force participation is not picking up. People are still staying home. You have excess savings. You have this massive skew in favor of goods versus services. So it is very much a new world, which I think causes all these surprises in terms of market behavior. And it's very likely to persist.
Yeah, unfortunately, we're out of time, and we didn't even get into commodity currencies, which, again, is another one of these strange things we have to contend with. George, it was really fantastic to have you on, having you in the studio and catching up with you today. That's George Saravellos, Global Head of FX Research at Deutsche Bank. Thanks again for joining us. Now, coming up, speaking of oil, crude talk, the oil prices are in a bear market, and OPEC Plus already has a lot to discuss at today's meeting. But now there's a new variant to contend with. We're going to look forward to that decision next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's get to the Bloomberg First Word News now. Here's Leanne Gerrans. Good morning, Leanne.
Hey, Danny, and thank you. Conservatives in the U.S. Supreme Court have suggested they are opposed to roll back abortion rights and uphold Mississippi's 15-week ban. In an argument that lasted almost 2 hours, all 6 Republican-appointed justices indicated they would let states start banning abortion far earlier than President now allows. Under a 1992 ruling, states cannot impose significant obstacles before fetal viability, which the court suggests was at around 23 or 24 weeks. And the Women's Tennis Association is suspending all tournaments in China, including Hong Kong, with immediate effect. WTA chairman and CEO Steve Simons says he has serious doubts that the star player Peng Shuai is free, safe and not subjected to coercion and intimidation. Peng's welfare has been in question since she accused a former Chinese vice premier of sexual assault. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne, thank you so much. Leanne Gerrans there. Now, OPEC and its allies are heading into a second day of talks on whether to pause their production increases. That's as the recent pandemic throws the outlook for next year into disarray. Joining us to discuss is Bloomberg's energy and commodities editor, Helen Robertson. Helen, good morning to you. Thanks so much for joining us. It does feel like not that long ago that we're talking about the possibility of $100 per barrel oil. It's so different now with this new variant threatening demand. How does that play in to OPEC's thinking today?
Good morning, Danny. Yes, you're absolutely right. I mean, how quickly things can change in oil and geopolitics. So as you mentioned, obviously, OPEC and its allies, so it's obviously Saudi Arabia and Russia being the key members there, they're heading into a second day of talks. Now, from what we know, traders and analysts are widely expecting them to put a pause on the originally planned increase of 400,000 barrels a day returning to the market. Now, there's a couple of reasons for that. Obviously, the discovery of the Omicron variant is very concerning for the market. Obviously, what happened last year when the globe was plunged into various lockdowns and mobility absolutely tumbled was that consumption fell as well hugely. And obviously OPEC is going to be very, very cautious in its approach because, they're going to want to avoid at all costs a repeat of what happened last year. So futures are up a little bit this morning. It's going to be really interesting, obviously, to see, sort of what they come up with. Yesterday, what happened was that there was a meeting of a technical committee to make any decisions, that those will all be taken today. But what they did say was that they estimated the market's going to be in surplus next year.
Helen, thank you so much. A fantastic preview of what to expect possibly. Maybe it is just a pause from OPEC later today. That's, of course, our energy and commodities editor, Helen Robinson. Just a quick check on oil for you. We're looking at WTI up higher by 2%. Crude is also higher by 2% as well. This came right as both of them in a bear market or are on the verge of a bear market. It really is one of these risk assets we've seen beaten up with equities as we get this concern over demand and what the new variant means. Now, smart conversations continue on Bloomberg Surveillance Early Edition. This hour, we're going to discuss vaccine access with the co-chair of COVAX. But up next, first, we have the European Investment Bank's head of the economic department who's joining us. We're going to talk all about the business environment for Europe. Send in your questions. IB plus TV Go. This is Bloomberg. The Omicron variant spreads. The U.S. reports its first case. Anthony Fauci says it was a matter of time. Apple drags tech lower after a supply crunch. Bloomberg learns that the iPhone maker now faces a new problem, slowing demand. And stay with Surveillance Early Edition. We speak to the economic head at the European Investment Bank and to the co-chair of COVAX. Send in your questions on IB plus TV Go. Well, good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. It continues to be a negative day in these European equity markets. Much of it has to do with catch-up to what we saw U.S. markets do yesterday. It's this continued shift to hawkishness from Powell at the same time. It's the spread of Omicron. At the end of the day, it's just uncertainty, plain simple uncertainty. That means there's not a lot of conviction. And with richly priced markets often using it as an excuse to sell, we're also looking at the lira heading towards new low with the finance minister replaced once again. Well, let's stick with that Omicron story, which has officially reached the U.S. The CDC has confirmed a case in California. The patient was fully vaccinated, has mild symptoms that are improving, and is currently self-isolating. Top U.S. infectious disease doctor Anthony Fauci was hardly surprised by the development.
We knew that it was just a matter of time before the first case of Omicron would be detected in the United States.
Now, over at the Fed, Loretta Mester says she's open to faster tapering to win space for potential rate hikes. The Cleveland Fed president told Bloomberg exclusively that higher rates in 2022 may be needed.
Right now, with the inflation data the way it is and with the job market as strong as it is in many dimensions, I do think that, we have to be in a position that if we need to raise rates, a couple of times next year, we're able to do that. So again, quickening the tapering gives us that optionality.
Let's now focus on Europe, where companies are looking forward to expanding again. That's one of the conclusions of a new survey published today by the European Investment Bank, the EU's long-term lending institution. Among its other findings, EU and national responses to the COVID crisis have helped keep businesses open and shielded their investments. On climate change, 43% of EU firms said they have already made climate-related investments, more than in the U.S. And 46% said they have become used to the they've used the crisis, to become more digitized. Well, joining me now from Luxembourg is Deborah Revoltella. She's the director of the economics department at the EIB. Deborah, thanks so much for joining us this morning. Let's start with one of those main points here. We're making our way through the pandemic. It's perhaps not gone, but it's started to normalize. And what sort of position do European businesses find themselves in?
I think what we see is that European firms are now in a good foot to restart and to catch the opportunities of the recovery. But we still see some risk in front of us. So far, so good. The policy support deployed by the European Union and by member states helped the firm to react to the shock. We see 49% of firms that have been experiencing a sales drop during the crisis, but also 56% receiving a form of support, either in terms of subsidies or temporary delayed in payment or guarantee credits. And this policy support has been quite important because it helped firms to hold to their investment plans, shielding the effect of the sales drop for them. So what we see is really that the policy support has been instrumental to keep firms focused on investment activities, which is what you need after a crisis like the one that we have seen.
And there's, of course, renewed concern that in Europe, a lot of this demand weakness is going to continue because we're seeing new mobility restrictions put on, new travel restrictions put on. What have you learned in looking over the past year how firms have reacted to support in order what's necessary to make sure that they survive potentially another wave of lockdowns?
What we've seen is that European firms have also taken the opportunity to transform in this phase of the crisis. 46% of firms have made investment to become more digital. This, we speak about starting a digitalization journey. They have been starting to sell online, work remotely, but not advancing digitalization. But this is a good starting point for the future, for adapting to a much more accelerated transformation of the digital work. What we are concerned, however, is that asymmetries across firms are increasing, and there is still 26% of firms that didn't do anything. And there is a group of firms which have been touched by the crisis. It may be an issue of some specific sectors, but we are concerned on what will happen to these firms in the moment in which the policy support will somehow be reduced. On the other side, another element that we are looking at is related to skills, and the skills remain.
Apologies for interrupting you. I definitely want to get into skills, but I just wanted to pick up on one note you mentioned before we move on to that. And that's this idea of what happens when support is removed. A lot of the companies you talk about are coming out in a pretty strong position, but how at risk are we of seeing many zombie companies in Europe?
So far, we didn't see, but there may be a lot also related to the policy support that has been helping firms in this phase. But what we see that is quite interesting is that the support was not wasted with zombie firm ex ante. So one of the things that we find is that in allocating the policy support, there were screening mechanisms to avoid to support the firms that were already zombie before. So there was no waste in this direction. But the concern of what will happen going forward for firms that have been strongly impacted and were not able to transform is still there, because so far we didn't see anything coming up. And actually the default rate of companies are much below normal times today.
Okay, well, let's get into that skill conversation and the labor shortage conversation as well. Just how big of an issue is this?
Since a few years, we find that lack of skills is the major impediment for European firms to invest. Actually, today, 80% of firms speak about a lack of skills as an impediment. And I think this is also a very interesting point to reflect on in this moment of the crisis. At the European level, the policy support was targeted to keep people on the job. So the furlough scheme allowed adjustment in terms of our work, but still keeping people attached to the job. It's a big difference to what happens in the US, and we see it in the labor market, where in the US we now have a lot of friction in the rehiring phase after the big increase in unemployment, and in the Europe we don't see it. But the problem that I see is that in the same time, we didn't see retraining of people. Actually, companies that were keeping people attached to the job, they were doing a much less training. And in a labor market that needs some transformation and needs people to learn new skills related to digitalization on one side or also to the climate transition.
Deborah, thank you so much for joining us. Unfortunately, we're out of time. Really fantastic to have you on the program today. That's Deborah Revolta, Head of Economics Department at the European Investment Bank, live there from Singapore. I want to bring us some breaking lines just crossing the terminal as well. The IOC, the International Olympic Committee team, has agreed to a personal meeting with Peng Shuai in January. This is, of course, the Chinese tennis star where there were concerns about being able to hear from her. The IOC also says it held another video call with Peng Shuai as well. Of course, this comes at a time when the WTA, the Women's Tennis Authority, has been looking at potentially handling this through China as well. Now, coming up, we're going to be talking to the co-chair of COVAX about the distribution of vaccines in the shadow of a fresh mutation. That's next. This is Bloomberg.
Additional mutations, but the clinical significance of those mutations is unknown. So I think we really have to wait for the data, and I don't expect that there is a significant drop. If there is a significant drop, then Pfizer has a playbook to develop a new vaccine.
Pfizer's Ralph Renner there speaking to Bloomberg earlier. Now, sticking on Omicron and vaccines, richer countries have been responding to the Omicron threat by ramping up booster shots, which is precisely the opposite of what the COVAX vaccine initiative thinks they should be doing. One of the executives behind the UN-backed scheme insisted the priority should be inoculating people in developing nations. For more on this, we pass it over to our European correspondent in Brussels, Maria Tadeo. Hi, Maria.
Yes, Danny, and this is such a timely debate. And of course, you know, what a joy that we're joined by Chrysoula Zacharopoulou, who is the co-chair of the COVAX initiative. You're also a doctor by training, so of course you know what you're talking about. You know, I have to ask you, COVAX, this is where the richer nations provide vaccines for some of the poorest, but we're seeing all of these mutations happening. Is COVAX, in your opinion, at this point working?
Yes, thank you very much for this question. Yes, I believe that COVAX is start to work because it has vaccines. That means the problem until now was the shortage of vaccine. You remember at the beginning of the crisis, the manufacturers had not vaccine to provide us. And the rich countries were the first who bought, and they bought a lot. So COVAX had a deal with the Serum Institute of India. But because of the catastrophic sanitary crisis in April 2020, COVAX had not vaccine to deliver.
Yeah.
So now we have the donation of the rich countries. We have the vaccine which are arriving from the manufacturers, and is the time where we accelerate the distribution. And if you see the news, 2 days ago, Seth Berkley, the president of Gavi, said that in 24 hours, COVAX distribute 11 million of doses. That means now we have vaccine, we accelerate.
So you don't buy this theory, because the criticism is that, yes, you know, the rich countries promise, but the fact that we're seeing mutations in South Africa, India, and so on, it shows that in reality, you know, this program at times looks like a failure. You don't think it's a failure?
It's not a failure. As I told you, I don't believe that is a failure of COVAX, but it's a responsibility of the manufacturers, but also we have to be honest. If at the beginning we didn't have vaccine, also if you create the best mechanism, you have to have something to deliver. Now that we have the vaccine, we can deliver, and the problem will be maybe the opposite, that we have a lot of vaccine which are arriving in COVAX. Now we have to be careful because when we send in countries, in some poor countries, we have to ensure that the deployment can be successful.
And the hesitancy at times. And I have to ask, as a doctor, this is the question now. If you have to choose between a booster shot for someone already vaccinated or someone who's unvaccinated needs to receive the first dose, where should that vaccine go? To booster for a person or first-time vaccination?
Okay, now I will answer like a doctor. I prefer to give my dose to somebody who was not vaccinated.
Okay, that's a very strong.
I think that, listen, for me it's unacceptable. We explain, the scientists explained that this is a pandemic. And when you have this pandemic, we have to be vaccinated, all of us. We have to stop to think that because we are vaccinated, the problem is resolved. No. And of course, it's unacceptable that the African continent is only 7%
vaccinated.
And
you say my booster would go to a first-time vaccination. Yes. That would be your choice. And I also have to ask you, the European Union, once again, is getting a lot of blame over the IP. Should the IP, the copyright of some of these vaccines, be removed? That's a real debate now. Should we remove the IP to accelerate production, perhaps?
In this crisis, I have to be honest, I'm very, very proud to be a European citizen because Europe has carried the global solidarity from the beginning. We create COVAX. We create the mechanism of donation. America said at the big America first. This was the Trump's America. Of course, now with Biden administration, they are back. We are very happy that we work together. Let's talk about intellectual property. For me, intellectual property has not to be the limit for the vaccination. So, the WTO, the World Trade Organization, has to take a decision. But we have to work also with the industry. And we have to find a compromise. President Biden announced that he was in favor of lifting of patents, but he didn't do a proposal. European Union did a proposal.
So you're saying America has all talk but very little action until now?
It's not, I think that the announcement is good, but I want to see the proposal.
What do you say, just very briefly, to some that say you're trying to protect European companies? BioNTech is a German company. That's why the EU is not giving away the IP. Just very briefly, is that a concern, the damage that it could do to a company like BioNTech, the money they could lose?
No, because, I don't work for the industry.
Okay.
First of all, I never worked for the industry, neither like a doctor, neither today. The question is that the innovation is very important, the research is very important, but I think the industry has also a responsibility. So I believe, as European Union, we believe the first scenario is encourage the voluntary licensing, like the example of AstraZeneca in India, because the reset, yes.
But you're saying, of course, since we're out of time, you're saying it's not about protecting Germany's economic interests and you don't work for the industry. You make that very clear. And we want to thank you, of course, for your time. And we hope to see you back on the show. Chrysoula Zacharopoulou, she is, of course, the co-chair of the COVAX Shareholder Council. Danny?
Maria, thank you so much. Maria Tadeo there, a very fascinating conversation with the co-chair of COVAX about mostly the importance of getting vaccines to emerging countries. Now let's go over to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Danny. Hermès is set to join one of Europe's main equity benchmarks, further bolstering the French luxury company's visibility among investors. The maker of Birkin handbags is to replace Universal Music in the Euro Stoxx 50, effective from December the 20th. Hermès has been benefiting from a boom in luxury demand that accelerated during the pandemic. And UniCredit is planning around 3,000 more job cuts as its CEO, Andrea Orcel, focuses on profitable business after an era of restructuring. Sources tell us that many of the cuts will come from the Italian lender's corporate centre to reduce bureaucracy. Orcel is also set to boost the bank's current dividend policy and focus on more lucrative products. And that's your Bloomberg Business Flash. Danny.
Leanne, thanks so much. Leanne Gerrans there. Now, coming up, first, it was a global supply crunch. Now, Apple faces a different problem, slowing demand for the iPhone 13. We have that story for you next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's get to a Bloomberg scoop. And Apple, suffering from the global supply crunch, is now confronting a different problem. That's slowing demand. The company is said to have told its component suppliers that demand for the iPhone 13 lineup has weakened, signaling that some consumers have given up trying to get the hard-to-find device. Apple is down pre-market. For more, let's get over to Bloomberg Quick Takes Alex Webb. Alex, what is driving this, or what do we know about what's driving this weakening demand?
So there are two things happening here. Firstly, we know that Apple has told its suppliers that it isn't going to be able to make as many iPhones as it wants because it hasn't been able to get all the components, not least semiconductors. We know about the big global semiconductor crunch at the moment. Now, the effect of that is that they had hoped that demand, even if they couldn't satisfy demand at the moment, they would be able to do it next year and the demand would still be there. Problem is, the further you get into next year, the closer you get to the new iPhone. And frankly, the iPhone 13 wasn't a significant upgrade on its predecessor. The next one is expected to be a more significant jump. So perhaps consumers are sitting there going, well, I don't want to be getting a phone in February, March, when I could be getting an even better one come September, October, November. And so Apple is now telling its suppliers it doesn't think that demand it had hoped would arrive in the first half of next year will be as resilient.
Alex, we're also looking at this breaking story, a story that broke in the past hour of another Apple-related story. Its partner Foxconn in talks to help Saudi Arabia build EVs. What's the background to this one?
With another Debbie Wu scoop. She's responsible for the other Apple scoop too. So Foxconn, which manufactures a lot of the iPhones for Apple under contract in China, it has also been accelerating into the automotive space. We know that with electric vehicles, it's a lot less complex to build a car than it is with combustion engines. And so that has lowered the barrier to entry, made it easier, in particular, for third-party contract manufacturers to build them. Saudi wants to build a domestic automotive industry. It's invested quite heavily in Lucid Motors, an EV startup. And now the story says that they are talking with Saudi is talking with Foxconn about building a factory in its home country that can build a domestic electric vehicle.
Alex, thanks so much. Everything from hardware to EVs. On top of it all, that's Bloomberg Quick Takes Alex Webb. Now, let's go ahead and check on these markets as we close out the hour, continuing to see negativity in the European session. Not as severe as we saw in yesterday's U.S. session, but still drops of nearly 1%. Because of that Apple story, we're looking at tech as the biggest drag. Now, Surveillance Early Edition continues in the next hour. This will continue to be a conversation as markets try to find their way through this continued pandemic. This is Bloomberg.
Whether it's Omicron or Delta or any of the variants, we know that vaccines are likely to have some protection.
It's too early to know precisely the impact economically. We need to learn more about the transmissibility and the severity of this variant.
We're learning more every single day, and we'll fight this variant with science and speed, not chaos and confusion.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It is 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Thursday, December the 2nd. Our top stories today. Is it time to buy the dip? JP Morgan says market turmoil caused by the Omicron variant may offer investors an entry point. Decision day for OPEC+. The cartel and its allies are debating whether to call a halt to their oil production increases. And Apple hits another speed bump. The company tells suppliers that consumer demand for the newest iPhone is slowing down. Welcome, everybody, to Bloomberg Surveillance Early Edition. I'm Anna Edwards, live in London. And Kailey, really interesting to see. Actually, the new information at the margin around the new variant has actually been quite positive, whether it's the WHO or GlaxoSmithKline or our conversations with Pfizer. That's not helping European markets, though.
Yeah, I wonder if European markets are just catching up to the selling we saw later on in the U.S. session yesterday. That said, the picture does look a little bit better this morning. It looked decent in Asia, a bit mixed when it comes to the equity gauges. Japan was lower, but China and Hong Kong were higher. And all said and done, the MSCI Asia Pacific Index did close in positive territory, but only by about 0.25%. And some of the biggest underperformers within the Asian session were suppliers to Apple. And that is after Bloomberg reported that Apple has told its suppliers that demand for the iPhone 13 is slowing down. So that weighed on the likes of LG Innotek, which was down about 8.4% in South Korea. Now, interesting action in the bond market as well, specifically at the shorter end of the curve in New Zealand. The 2-year yield up about 8.5 basis points to 194. And then the Japanese yen not getting any kind of safe haven bid today. It is the biggest underperformer in both Asia and G10, weaker against the U.S. dollar by about 0.33%, sitting at 113.15. Now, here in the U.S., we did see that late selling yesterday. It got uglier as the session grew older. And as a result, the S&P 500 is coming off of its worst 2-day decline since all the way back in October of 2020. This morning, though, there does seem to be a little bit of dip buying action. We will see if it holds. Right now, S&P 500 futures up about 0.3%. In the bond market, a bit of a reversal from yesterday as well. Yields moving higher by the better part of 4 basis points on the 10-year Treasury to 144. Still, though, more movement at the shorter end and through the belly of the curve as a result. That yield curve is still flatter on the day. The 530 spread now sitting at 58 or so basis points, just south of 59, which is the flattest since March of 2020. And then, of course, all eyes will be on oil today. What will OPEC Plus decide to do in the face of the Omicron variant? Do they decide to just hold production steady in the month of January? That will, of course, provide a major cue for the oil price. But right now, prices are moving higher, Matt, up 2.6% on WTI. Yeah. We're trading at $67.25 a barrel.
Yeah, that'll be very interesting to see if they perceive Omicron as actually denting demand rather than just a big news story that we talk about every day. Take a look at what's going on in Europe in terms of stocks. A little bit of a mixed picture, but for the most part down, with the major indexes off about 1%, the DAX off about 1%, the CAC 0.75%, the FTSE down about 0.2% right now. The interesting thing really is in the currency story. The Turkish lira being first and foremost a big headline this morning after Erdogan has abruptly let go of his finance minister, replacing him after only 12 months on the job amid a debate inside the administration about the aggressive rate of interest rate cuts and how that's fueling inflation, how that is undermining the currency. Of course, we know that the Turkish president, Erdogan, doesn't believe that cuts are fueling inflation. In fact, he thinks lower interest rates will help to fight inflation. Here you see the lira, 13.5 right now is the amount you can buy for $1. I also thought it's interesting you're seeing some strength in the pound against the greenback, although the dollar is just generally weaker today, stronger against the yen, but generally weaker against other major trading partners. I've got Brent as well right now at 70.59, so I'm watching oil as well, up 2.5%. Will be interesting to see how the Omicron variant affects OPEC's decision. And then Bitcoin has been doing a whole lot of nothing lately, but we're looking at positive futures, Kailey, you just showed us in the U.S., and that's not helping. That kind of risk-on sentiment in America, not helping Bitcoin, maybe because stocks in Europe and are taking a little bit of a hit.
Yeah, absolutely. Really difficult to get a sense of how risk on or risk off we're feeling at the margin here in the global conversation, because, of course, we've got these European assets just simply playing catch up, it seems, or catch down with the Wall Street story from yesterday. Now a look at what is ahead today. We've mentioned it a couple of times. OPEC Plus ministers meeting today to decide on the group's production policy for the next month. The market expects a pause in output. Now at 8:30 a.m. New York time, we'll get U.S. initial jobless claims, and at 11:30, San Francisco Fed's Mary Daly and Richmond Fed's Tom Barkin discussed the labor market and inflationary pressures, two crucial angles for the Fed, of course, at a virtual event of the Peterson Institute. We will also hear from Atlanta Fed President Raphael Bostic and Fed Governor Randy Qualls today. I mean, that's pretty much everybody, isn't it? That's a lot of Fed governors all in one day. So lots, I'm sure they will have to say on where they see the world right now and what Omicron could do. Let's think about what Omicron could do. The first confirmed US case of the Omicron coronavirus variant has been detected now in California. The CDC says the patient is a San Francisco resident who traveled from South Africa. They were fully vaccinated and have only mild symptoms. Meanwhile, GlaxoSmithKline says its COVID-19 antibody treatment looks to be effective against the Omicron variant in early testing, and Pfizer says it expects its vaccine to hold up against the new variant. I spoke with Pfizer's Vice President Ralph Reinert earlier today.
There are some additional mutations, but the clinical significance of those mutations is unknown. So I think we really have to wait for the data, and I don't expect that there is a significant drop. If there is a significant drop, then Pfizer has a playbook to develop a new vaccine.
So, as I was saying earlier, some of the most recent information around Omicron does not seem to be as gloomy as perhaps it has been in other days. But what does this mean for volatility, for investors? Investors are bracing for more volatility as the Omicron variant complicates the outlook for the pandemic recovery. A lot we don't know still. Bloomberg's Danny Berger has the latest on the market response. And the market response is pretty confused today across the Atlantic then. Danny, what are you seeing?
Confused is probably a good adjective to use for the past few days. And look, yesterday, a market sell-off sparked by a case in the U.S. of Omicron. It's not a surprise to a lot of people. So if anything, this really shows just how fragile markets are at this moment. It's not just a new variant, it's also Powell starting to shift this more hawkish direction at a time where assets were already very richly priced. Puts, also protection on this equity market has been very cheap. So this is what it's resulted in. For our radio listening audience, I have both the VIX and the MOVE, both measures of volatility for the stock and bond market, up on the screen in front of me. Both of them have ever so slightly started to creep higher. And I should say for equities, it was quite a big move higher as well. So if puts are cheap, it makes sense to hedge yourself at this moment because uncertainty, along with confusion, that seems to be the word of the day. We're heading into the end of the year. So for a lot of people, especially hedge funds, which according to Goldman Sachs are at a year low position, have started to close out their positions saying, okay, I'm just going to stay on the sidelines for the rest of this year.
All right, Danny, but some strategists are saying don't stay on the sidelines. Now could be an excellent buying opportunity.
Yeah, for those who are brave and think we'll still get buying the dip versus selling the rallies, now is a great time. And Marko Kolanovic from JP Morgan, along with his team, think that this is the current case we find ourselves in. Not just buying the dip, but this is actually a good thing. He says Omicron could be a catalyst for steepening, not flattening the yield curve, rotation from growth to value, a sell-off in COVID and lockdown beneficiaries, and rally in the reopening themes. He thinks that because Omicron is weaker, even though it might spread more, that it would be good. The recent sell-offs, these segments, it's an opportunity to buy the dip in cyclicals, commodities, reopening themes. And of course, when you think about cyclicals, you have to talk about the European markets. Bloomberg, we just did our survey of year-end for 2022 estimates, kind of similar to what Marko Kolanovic is saying. We're seeing gains of 9% through year-end of 2022, according to this survey. The biggest growth of which, Anna, that analysts see here is really robust earnings for these European equities.
Will we still be saying the word Omicron at the end of 2022? I really hope not. Danny, thank you very much. Danny Berger with us on the latest on market expectations around Omicron. Of course, the Fed very much in there as well. Now the latest Bloomberg scoop. Apple, suffering from the global supply crunch, is now confronting a different kind of problem, slowing demand. Bloomberg has learned the company has told suppliers that demand for the iPhone 13 lineup has weakened, signaling that maybe some consumers have given up trying to get hold of those hard-to-find devices. Tom McKenzie joins joins us now. And Tom, good morning. So what is it that we've learned then from our sources about what is the outlook from Apple?
Apple is becoming a really fascinating example of these evolving supply-demand pictures and what is happening within this environment. So we know, you'll remember this, that they cut their forecast for total units in terms of the iPhone 13 by about 10 million units because of supply constraints, because they couldn't get hold of chips and other components that go into the iPhone 13. Now they've turned around and said to suppliers, well, the demand is starting to fall off. People are deciding they're not going to go out and buy the iPhone 13. You can imagine part of this is down to the fact that you have to wait weeks, months in some cases to get your hands on these products. So some consumers just holding off, not bothering to do that. Inflation, of course, another factor as well, at about 6% in the US across the board, so maybe pressure on consumers there. Apple had hoped that come next year, you'd have seen that demand pick up and make up for that loss production that we're seeing in 2021. It doesn't look like that's going to happen.
Yep. Well, maybe it's inflation, right? Maybe it's fear of the Omicron variant. We really don't know what's driving consumer behavior. It could be that they just don't love the iPhone 13.
It absolutely could be that. Look, the changes around the iPhone 13, as you know, Matt, were not seen as significant or particularly material. So maybe it's a question of consumers waiting amid these drawn-out wait times for these iPhone 13s, waiting until 2022 when you could get the new model coming out, maybe the iPhone 14 is what they're going to call it, which is expected to have more souped-up features. So that could definitely be a component. It's worth pointing out, they're going to have a very good season, a very good holiday season. The analysts expect the third quarter, the revenues will come in up 6% at about $118 billion US. It's just not going to be the blowout blockbuster that Apple had hoped for in the earlier part of this year.
Tom, thanks very much. Bloomberg's Tom McKenzie there, covering the big tech story of the day for us. Let's get to politics now in Washington, D.C. The federal government moved another day closer to a brief weekend shutdown, with congressional Democrats and Republicans still struggling to agree on a stopgap measure before Friday's deadline. Jack Fitzpatrick, Bloomberg government reporter, joins us from Washington. Jack, so what does it look like? Will the government shut down?
It's looking more and more likely that there's going to be a probably brief shutdown. There's a fight over Senate conservatives trying to hold up a stopgap funding measure, saying that they want to insert a measure that would block vaccine mandates, the OSHA vaccine and testing rule. If they want to hold this up, even if there are 60 votes to end debate, the procedural issues in the Senate could drag this out definitely past Friday. There are some other separate issues, so we don't even have a stopgap measure that has been released yet. So there are a few things they're working through, and the question is how fast can they introduce it, get it through the House, and then work with Senators Roger Marshall, Ted Cruz, Mike Lee to see if there's any kind of deal that could happen. But yes, as of right now, unless something changes, at least probably a couple-day shutdown is likely.
Well, Jack, just down the street from the Capitol building is the Supreme Court, which heard arguments yesterday in Mississippi's abortion ban after 15 weeks of pregnancy, indicating they may be poised to roll back abortion rights. What would the implications of that be from an electoral standpoint as we look ahead to the midterms in 2022?
There would be a lot of significant implications. Obviously, Supreme Court watchers have said that a lot of the indications, especially from the three new conservative judges, were that they appear to be considering taking out that Roe v. Wade precedent. Electorally, this would be a massively motivating issue for Democrats. It's too early to say if this would undo the struggles that you've seen in the polls for Democrats heading into the 2022 midterms, but clearly it would be a defining issue. And it would also complicate a lot of other issues. One of these government funding debates is over the Hyde Amendment, which restricts federal funding for abortion. It would open up a major can of worms, but also be a motivating factor, probably for both sides, especially Democrats, in 2022.
All right, well, we will look ahead to that decision from the Supreme Court expected later on this summer. Thank you so much to Jack Fitzpatrick of Bloomberg Government. And now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. A big one to the upside is Snowflake, of course, the cloud software company. It reported after the bell yesterday, positive on revenue, and the guidance also was really strong. So as a result, that stock up about 15% in early hours. Another stock higher is Vir Biotechnology. And of course, we were reporting that GlaxoSmithKline's COVID-19 antibody treatment does look like it actually works. against the Omicron variant. And its co-developer of that drug is this company. And as a result, those shares are up about 6.6% in early hours. One mover to the downside, though, is a COVID-19 vaccine maker, Moderna. It could be lower for a third day in a row. It's already lost about 16% over the last 2 days. It's down another 4.4% this morning. Part of this is concern around efficacy against the variant, but also some legal issues with them losing a battle yesterday, Anna.
Yeah, absolutely. We'll keep an eye on Moderna. Interesting, we spoke to Pfizer. We played a clip of it earlier, didn't we? A slightly more positive take on the effectiveness expectations around their vaccine. Sticking with the subject of Omicron, I just want to get to a briefing that's taking place. The WHO operating a briefing on WHO Africa, this is. They're saying, they're giving us their take really on what we know so far about Omicron, urging countries to accelerate genomic sequencing, also saying more than 80% in Africa haven't had a single vaccine dose. We're hearing from Professor Anne von Gottberg, clinical microbiologist at the National Institute for Communicable Diseases in South Africa. She's giving a fairly gloomy take, actually, saying that previous infection doesn't protect from Omicron. I suppose we've anecdotally heard of other people, maybe some of us know other people who also have had other branches of this virus twice. So we will see whether that is as substantial as perhaps that sounds. We'll get further details on that. We'll keep monitoring this briefing. Coming up on the programme then, returning towards record lows, more on the weakness in the Turkish lira. And should investors buy that dip? We talked about it earlier with Danny. We'll speak with Willem Sels, HSBC Private Banking Global CIO. Plus, it's decision day for OPEC Plus, and all options are on the table. More ahead. This is Bloomberg.
Welcome back to Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Kailey Leinz in New York and Anna Edwards in London. Now, we've been watching the Turkish lira hit record lows again and again lately as President Erdogan reiterates in various ways his view that cutting rates is the best way to fight inflation and stem the drops in the currency. Now, every day, Mr. Market doubts him, and most recently, Turkey has actually intervened in currency markets for the first time in 7 years to try and stop the drop. Now, I've got a chart here, which I will explain for those listening on London DAB Digital Radio. Good morning to you. It shows Turkey's net reserves. This is how much they essentially have in their war chest. Now, the gross number would be negative, so we're using the net to show you it's about $25 billion. This is essentially what they have left to use if Mr. Market says, all right, I'll take you on in that fight. Let's talk to Ven Ram about it, currency and rate strategist at Bloomberg MLive. Ven, so we know that President Erdogan most recently has dismissed his finance minister. This is another chance, I guess, for the market to take on Turkey.
Absolutely, Matt. I mean, they, as you mentioned, they intervened for the first time in 7 years yesterday. They're kind of signaling to the markets that here, we are ready for a fight if you want it. And I don't know if that's great messaging because, you know, considering the reserves that they have, whether you look at the gross reserves or the net reserves, they do not have a very big war chest. And if you look at it in the context of the imports of the nation, it's hardly enough to cover a few months of imports. And against that backdrop, you don't go into the markets and say, we are going to intervene and defend the lira at a time when you've got deeply negative real rates and at a time when the Fed is looking to go faster on its taper and start raising rates. That's hardly an environment in which you would take on the markets. But there you go, that's what they are doing. And we have already seen the lira. Yesterday, it pulled back. Now it's coming back down again.
Yeah, it supported the lira for a little while, didn't it? But it didn't last all that long. Ven, pivoting to the risk-on, risk-off trades that we're seeing in FX markets at the moment, risk-off days seem to be good for the euro. We've been talking about this since last week when we were really puzzled. There have been a few suggestions, and you've been doing some thinking on this. What's your assumption? What are you suggesting is the reason behind this?
Now, we saw this, Anna, play out in 2020, actually. So if you look at what happened immediately after the pandemic, rates collapsed around the world. And it was the euro that was bid. It was in the dollar, and we are seeing that playbook being played all over again now. And I do think that if there is going to be a severe risk-off with Omicron, and i.e., what do I mean by the severe risk-off? It is defined by the Fed going slow on taper and not raising rates. That would mean a bid for the euro.
Ben, thanks so much. Ben Ram of the Bloomberg Markets Live team, thank you very much. Remember, you can get a market analysis. MLIV Go is the function to use on your terminal. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in Berlin and Kailey Leinz in New York. The WHO Africa is holding a press conference team, and then we brought headlines earlier on that suggested that previous infection was not helping against Omicron. But then we see other headlines coming from it saying that certain parts of South Africa may see lower rates because of previous infection, Kailey.
Yeah, and vaccination. So some conflicting guidance here. Of course, we all are just awaiting more clear data, and we understand it could take more days and weeks for us to get that picture, Anna.
Coming up, conversation with Willem Sels. We'll talk to him about investments. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in Berlin and Kailey Leinz in New York. And Matt, we're monitoring this press conference taking place, WHO Africa leading a press conference, the WHO there, and some seemingly concerning lines, perhaps weighing on risk appetite just at the margin. We saw a bit of a dip in futures as a result of some of these lines, but then that dip being bought. So we are keenly waiting for anything we can really treat as fact, I suppose, when it comes to the Omicron variant.
Yeah. Some conflicting headlines coming across. I thought it was concerning that we heard from Professor Dr. Gottberg that previous infections don't protect against Omicron. Now, we know that typically, at least from a layman's understanding, previous infections or vaccines should protect at least somewhat against new infections. But if the previous infections don't help you, then you have to wonder if vaccines are going to help at all either, because it's all about the antibodies, right? Maybe Professor Dr. Gottberg meant to nuance that a little bit.
Yeah, I mean, and then we're back to asking a lot of questions, aren't we, about the effectiveness of vaccines? And as we played it earlier on in the programme, we asked Pfizer a little bit earlier on European time about that, and that they seem to express some confidence that we wouldn't see a material drop-off in effectiveness of the vaccine. But we'll wait to see. Some differing opinions then coming through from this WHO Africa panel. How's that weighing on markets or not, Kailey, as we head towards the start of US trade?
Well, it really just speaks to the broader uncertainty around this variant, its transmissibility, its lethality, and what we know is that the market really doesn't like uncertainty. So that has driven it a little bit crazy in the last several sessions. And of course, that led to the worst two-day performance for the S&P 500 going all the way back to October of 2020. It is looking a little bit better on the U.S. side this morning. Futures up about 0.5%, but stocks are down in Europe. Every single sector in the stock 600 in the red. Technology actually leading the losses. That broader index down about 1.2%. But we have to keep in mind a lot of the selling pressure was late in the U.S. session yesterday. So Europe may be playing a little bit of catch up on that front. In the bond market, yields are moving higher, though, off of the highs of the session. We're up the better part of 3 basis points on the 10-year Treasury yield to 143. And then, of course, all eyes will be on OPEC Plus today and their output decision for January. Does the Omicron variant mean that they decide to hold instead of adding another 400,000 barrels a day to its output? It'll be interesting to see what that does to the oil price. Oil, of course, is in a bear market, but right now, Brent crude is up the better part of 2%. $70.19 a barrel is where we trade at the moment. And of course, one of the big individual company stories we're following today is when it comes to Apple. Apple reportedly telling suppliers that demand for its iPhone 13 is slowing down. So that is weighing on that stock. It's down about 2% in pre-market trading, and its suppliers lower as well. The likes of Qorvo, Skyworks Solutions, and Qualcomm all down about 1% or more. Matt.
I have one of the coolest charts I've seen in a long time here, courtesy of my London producer, Daniel Curtis. I'm not sure if he stole this from Cameron Crees or not, but it's just amazing. Yesterday, the volatility that we saw, you know, the S&P shooting up more than 1% gain and then dropping on the incredibly obvious headline that someone in America has the Omicron variant of the virus. It seemed to me so amazing, that kind of volatility. And in fact, it's pretty unprecedented. This chart shows, for those of you listening on Bloomberg Radio, we've only seen it happen 17 times since the 1990s, 1980s. This kind of rise from a close the day before and then drop into negative territory. And some of those times were like the long-term management crisis, the great financial crisis, the China concerns about Chinese default. So there's been pretty major issues that have forced that kind of volatility in the market, and yesterday was one of those days. Willem Sels joins us, HSBC Private Banking Global CIO. Willem, what does it tell us about how this market is priced that an incredibly obvious headline, something I think we all would have guessed is the case, drives a 2% and change sell-off in the S&P 500?
Yeah, we've had an almost uninterrupted rally, of course, this year in the S&P, and obviously there's always a little bit of temptation to take some profit here, you know, especially as there are so many different variables. You know, obviously we're now talking about Omicron, and clearly there the jury is still out. The data is not yet in on the final verdict on whether it is spreading more quickly, whether it's more deadly. And then at the same time, obviously we have OPEC. We also have you know, the Fed and other central banks potentially changing their tone. I think what people need to keep in mind for 2022 as a whole is that we're still in the mid-cycle, so growth of the economy and of earnings should still be decent. And even if central banks start to hike a little bit, rates still remain low. So it is still a positive environment, but obviously more volatility in store, and you need to build resilient portfolios.
Willem, good morning. So how fundamental are the changes we're going to see from central banks? Because we have seen this pivot from the Fed. It's either hawkish or less dovish, depending on your interpretation, but a bit of a change in tone from the Federal Reserve. Where does that take us back to? Does that take us back, in terms of the accommodative nature of policy, does it take us back to a pre-COVID period eventually? Is that where we should set our sights, or tighter than that?
It's a transition that is taking place, you know, both on the monetary and on the fiscal side, by the way, and it's taking place around the world. And so far, obviously, people, you know, central banks have been looking at it as transitory. Now we can no longer use that word. People are still thinking that it will fall in the second half of the year. Inflation will fall, and that's also our core case. But there is more uncertainty around this. So we're seeing tapering happening more quickly, and therefore also rate hikes starting, you know, next year as well. But it's still a low rate environment, and especially what's important for investors as well is to look at what a 10-year does, the 10-year Treasury, and we see that in a very volatile but range of 1% to 2%, so no drift. So we're actually still buyers of growth stocks. I think that's a bit out of consensus.
Okay, so no higher than 2%. 1.43 is where we trade on the US 10-year. What stops it from going any higher than that?
It's, you know, to some extent the expectation, obviously, that inflation will fall. You know, there is the impact of technology, for example, that is deflationary. There is the, you know, the labor market, which has become, you know, more global, certainly for people like us. You know, I have team members that have been sitting at home and have been sitting abroad for a long time. So, you know, the offshoring question is an obvious one, you know, around the world. Obviously, there are jobs that you need to do locally. Then there is the global savings surplus that is there, the global aging, etc. All of that, those structural forces keep it in that 1% to 2% range.
Willem, let's contrast what the Fed is doing with the ECB, which is growing a lot lonelier in a tightening world. How does that make you think differently about European assets relative to U.S. ones?
Well, for a start, obviously, it continues to help the US dollar, you know, which we think will continue to drift a little bit higher. Obviously, it has done already a lot over the last few months, you know, but a little bit of, you know, further upside for the US dollar, mainly because of that interest rate differential, that yield pickup that people are seeing. It's easier to find bonds in the US dollar market that are attractive, that have a decent yield for our type of clientele. I think when you look at the US versus Europe in the equity market, you need to think about what is the character of European stocks versus the US. And Europe has more cyclical stocks, and the US has more quality stocks. And so we don't particularly want to be too cyclical, and we want higher quality. So it points to us towards the US as the main overweight.
Points to the US. Willem, thanks very much. Thanks for joining us. Willem Sels of HSBC Private Banking with us on set here in London. Now, coming up on this programme, it is decision day for OPEC+. We will speak to Martijn Rats, global oil strategist at Morgan Stanley. Will OPEC+ decide to pause its output hikes? We'll get to that conversation next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, Etsy CEO Josh Silverman. That's at 5 p.m. in New York. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Anna Edwards in London and Kailey Leinz in New York. Now, Europe is facing an unprecedented energy crunch, and today energy ministers from across the bloc are meeting to discuss what to do to alleviate the pain. Italy is the latest EU member state warning about potential blackouts. For more, we go to our European correspondent, Maria Tadeo, live out of Brussels. So, Maria, I know prices are high, temperatures are dropping. How much of a concern is this?
Temperatures are dropping, and I'm not sure if you can see the snow behind me. And, you know, we're the start of December. This is going to be clearly a cold winter. And, Matt, you know, to answer the question, I think if you put away the mutation and the virus, which is, of course, the biggest question and the biggest concern for European governments, I would say the energy crisis ranks second. A lot of this, of course, feeds into the inflation narrative that we're seeing in Europe, whether this is a one-off or cool down or not. But it also feeds into what is a very important debate in Europe, which is the social fabric. There's many governments that do worry about social pushback in the winter if households are not able to heat up their homes properly. And as you know, we could also be entering an election period next year in Europe if Mario Draghi decides to leave the Italian government. And then, of course, the big French election. A lot of this feeds into both the political but also the economic debate. And ministers are meeting today in Brussels hoping to come up with a joint solution. Some of the southern European countries are saying we need the EU to step in. The problem is, until now, it does seem as every nation for itself. You have to come up with your own plan. There's going to be no joint European response for this.
Yeah, Maria, I should point out that is a window behind you. We didn't make you go stand in the snow with no coat on. That would have been cruel. You talk about, as you draw our attention to what looks like very cold weather, you mentioned government intervention, the possibility of that. Are there any signs of respite in prices then?
Well, you know, Anna, that was always a hope that prices would cool down, especially when you look at gas prices in Europe. And, you know, just don't take my word for it. Look at this chart that we've put together, which to me, this is a story, the energy crisis of Europe in 2021. If you look at December, that was last year, you see where prices in the gas market were trading at. You look at where we are now, this has rocketed by triple digits. If you look at the situation in Q4, starting in September, that's when the real crunch begins. We'll go back from the summer holidays, big concerns about reserves, but also Russian supply becoming very tight. The only meaningful decline we've had this year was Vladimir Putin saying that Gazprom would honor contracts, but as you can see, that's not really been reflected in the market ever since, and prices have continued to jump in what is already a cold winter. You know, you see the snow behind me, so you see that, you can take my word for it too.
All right, thank you so much to our European correspondent, Maria Tadeo in Brussels. And another key meeting for the energy world, it's decision day for OPEC and its allies. The cartel is heading into a second day of talks on production with the Omicron variant, a major wild card. Joining us now is Martijn Rats, global oil strategist and head of European energy research at Morgan Stanley. So, Martin, I know you expect that OPEC Plus is going to decide to hold production steady in January. Why?
Yeah, that is cool. Look, it's basically the default choice after you've excluded the other two choices, which are either to continue with the current trajectory of increasing output, which is the existing agreement as it is, or the other scenario is cutting output. Now, increasing output, given the uncertainty that exists around the Omicron variant, probably would not be appropriate. There's quite a bit of uncertainty about what it will really do to oil demand. OPEC's own supply-demand balances show a distinct weakening in the first quarter. So with that in mind, continuing simply with the path that OPEC is on and leaving the autopilot on, so to say, is probably not appropriate given the heightened level of uncertainty. But the other extreme outcome would be to actually implement an additional production cut. But the problem with that is that it's very hard to create consensus around that. And secondly, it would carry quite a lot of negative signaling value. I think the market will say, hey, what is OPEC really seeing there? And the market reaction to an actual cut could be surprisingly negative. So I think given the uncertainty, just keeping it flat seems to be the most appropriate course of action.
Yeah, I wonder, do we see any evidence that Omicron is actually affecting the market beyond, beyond the trade in, speculation, beyond media headlines? I mean, we're making a huge deal of it, right? But does anyone really say, I don't want to buy an iPhone because of Omicron? Does anybody really say, I'm not going to drive to my mom's house because of Omicron? Does it really affect consumer behavior?
Look, I think by now you have to be a little bit skeptical about this. The market is not taking this view. The market is trading as if this will lead to a very large amount of demand erosion in the early part of next year. But look, the sort of willingness of governments to put people into lockdowns has much diminished over the last sort of 12, 18 months. And then on top of that, people's willingness to then comply with these such very stringent rules is also increasingly running into popular resistance. So our thinking is that sure, jet fuel could be impacted when planes don't fly. But outside of jet fuel, the impact will be much diminished.
Okay, Martin, good morning. Before we were talking about Omicron, we were talking about strategic petroleum reserves and release by consumer nations to try and bring those prices down. Of course, we've seen those prices coming down drastically for other reasons. What kind of response do you think we'll get from OPEC Plus around that? What kind of response would they have given if Omicron had not been part of the conversation?
So there's a great deal of tension, of course, between the objectives of the producing nations and the consuming nations, so to say. I think that the situation is such that we've arrived at a situation where actually the core OPEC countries, particularly those in the Middle East, are less sort of sensitive to pressures from the Western world, as in they also see the sort of climate agenda, the net zero agenda. They're sitting on a large amount of resource still, and arguably still a long window to monetize those resources, but somewhat of a shrinking window. And if you're in that situation, then you think, well, hang on a second, we probably have 10, 15 years sort of, of a solid oil market left. We need to extract as much economic rent out of those resources as possible, which is also important for those own countries' sort of transition to whatever lies next. They need funds to organize their own transition, and therefore they're perhaps a little bit less sensitive to the demands of the consuming nations to drive prices down. I have to say also on the SPR release, we're talking about something that is sort of 1% of global observable inventories. Simply moving 1% of inventories from an SPR tank to a non-SPR tank doesn't fundamentally change the oil market. So look,
nothing compared to a new variant.
It doesn't change much.
Martin, we heard from JP Morgan earlier this week a report that made a little bit of noise saying Brent could hit 125 to 150 in 2023 because of a lack of spare capacity, specifically on the part of OPEC Plus. What is your read on what that spare capacity actually is?
So estimates of spare capacity vary quite a lot. If you look at estimates from the IEA, it could be as much as 6 million barrels. But that still includes 800,000 barrels a day for Iraq, nearly 400,000 barrels a day for Nigeria. When you go country by country, those estimates seem very generous. There are other estimates from a wide range of consultants out there that put it a lot lower. Something like 3.5 million barrels a day based on October production is broadly where we would put it. And then, if you then roll the clock forward over the next year or so, even if you take a much more conservative view about what OPEC actually will do over the next year in terms of production additions, we can easily see them adding 1.5 million barrels a day of production. And so when you roll the clock forward to this time next year, we could be having spare capacity sub 2 million barrels a day. And that would be a very low level.
Martin, thank you very much. Thanks for joining us. Martijn Rats, global oil strategist and head of European energy research at Morgan Stanley. Sticking with that theme, coming up in later programming, more on OPEC with Jeff Curry, Goldman Sachs global head of commodities research. That is at 10 a.m. in New York, 3 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz in New York with Anna Edwards in London and Matt Miller in Berlin. Tom Keene, co-anchor of Bloomberg Surveillance, also joining us now. So, Tom, we're looking at stocks, we're looking at bonds, but today especially commodities are also in focus.
Well, we're looking at oil. Bloomberg's done a phenomenal job, and behind the scenes, I mean, Matt Miller, he works like a 3-hour day, but we've got people really trying to book expert voices. And I want to brag here about the arc of the U.S. morning, from Martijn Rats, who you just heard from Morgan Stanley, over to Jeff Curry, who will be with us in, I think, the 10 o'clock hour New York time. And in the middle is the guy who says $150 a barrel oil is a scenario that's feasible. Christian Malek, and we'll have a great conversation with him here coming up on Surveillance. Of course, there's every other shock and awe as well. And, you know, Matt Miller, I'm sorry, we are all one-upped by the beautitude of Miss Leinz and Grant. Grant is, I mean, wow. I don't know what to say here. I think the thing is one part grizzly bear. I mean,
he does have massive paws, but he has the most adorable face, and he really is such a good puppy. We are very, very happy.
Well, good. And anybody that's dumb enough to name their dog Grant clearly needs a second dog named Lee. Let's go to the chart right now. And the chart is for Kailey Leinz because she has no idea how the wallet's going to be lightened up here at the vet in the coming months. This is the juggernaut if you have a dog in America. And it's Chewy. I don't understand why Jeff Bezos hasn't bought Chewy. The green circle at the bottom is where the Leinz household decided to acquire Grant. Chewy took off like a rocket. And Matt Miller, it's ebbed away here a little bit. That's the lightening of the Leinz wallet at the veterinarian.
I must say, I did place a massive Chewy order last night, Tom, and we're going to the vet for the first time tomorrow, so I'm sure that will lighten the wallet even more.
That will lighten the wallet as well. So there you go. Congratulations on
Thank you very much.
Grant.
All right, Tom Keene of Bloomberg Surveillance, thank you. And I am mostly distracted by my puppy, but there are other things I am watching today, including that OPEC Plus meeting. It seems to be that the market is expecting that they will hold production steady in the month of January due to the uncertainty around the Omicron variant. I mean, it's so interesting. And Anna, you alluded to this. The other day, we were talking about supply and the release of reserves. Now it is much more a demand story, Matt, and we'll see how cautious OPEC Plus is around that.
Well, I have to say, I question whether or not this is really a demand story. I mean, when you were considering the purchase of Grant, did you take the Omicron variant into account? Was it out yet? Would you have decided differently had you known about Omicron then? I doubt it would have affected anyone's decisions. But we are making a huge deal out of it, and it is definitely creating real price action, so that can't be denied. We're hearing also a lot of conflicting statements about Omicron, specifically from Professor Dr. Gottberg in South Africa. Not sure 100% of her qualifications or if she's being quoted correctly, but she did say, or we did at least have a headline saying that she says previous infections don't protect you against Omicron. If that's the case, do vaccines do any good? It seems like that could be a little bit of misinformation, Anna.
We're still in the early scramble, trying to pull together a picture really of what this variant looks like, and that search for those leads taking us in all kinds of directions. Let me just briefly mention we are seeing a meeting taking place between Secretary of State Antony Blinken and his Russian counterpart Sergei Lavrov. Lavrov saying further NATO expansion in the east threatens Russia. Blinken saying serious consequences if Russia pursues confrontation. We will keep monitoring this meeting for you. More Bloomberg Surveillance lies ahead. This is Bloomberg.